back to our intermediate financial accounting class. Over the last few segments, we've been talking about revenue recognition and all the new rules that are part of this process, which is perhaps the most important number in the income statement other than earnings per share. A lot of information contained in that revenue number and discussed and analyzed by the market. Now we get to continue our discussion of our income from operations section, moving to the next most fun topic, and that is pensions and pension expense. Now, pensions has been a huge issue for companies because it's a drain or a burden that companies did not anticipate. You see, for a lot of years, companies gave these really great pensions to people, and now they're realizing that they didn't really think of the whole cost. And so pensions are changing drastically. So this is going to be a really fun discussion. We'll talk more about why this is so important and how it works later. We're going to break our discussion of pensions into 3 pieces. We'll talk about the pension worksheet that companies use to do their pension calculations. We'll talk about how we amortize certain costs that are part of our pension and get shown on our balance sheet. And then we'll talk about how we actually record the pension cost. And that's the piece that FASB has just recently changed, is that pension cost. And so we'll talk about the differences between the old pension expense and pension cost. The first thing we need to talk about, just like we do with all of our discussions, is why we should care about pensions. The truth is, pensions appear to be a dying breed in the United States. If you go back to, well, my grandparents' time and kind of my parents' time, everybody had a pension. The company was going to take care of you once they hired you. But in more recent times, as companies have come to realize just how expensive it is to promise to take care of their employees until they pass on, and as lifestyles and lifespans have expanded, well, companies have realized they just can't afford to pay for it. This is not only true with just basic pensions where we're paying out a specific living wage, but also a lot of companies promise to take care of healthcare expenses too. And of course, those expenses have skyrocketed in recent years. So because of that, companies are starting to pull back, at least from what we think of as a traditional pension. What we're seeing instead is a new kind of pension. That's what we traditionally think of as a 401k, where I take a contribution from you, I match it a little bit, and that becomes your retirement savings. Those are still pensions. They're just not what we typically think of as a pension, where you're guaranteed a specific amount every month until you pass on. The other reason that we still care about pensions is because all of those old pensions from earlier generations are still in force, and a lot of government entities are still offering pensions, as are some high-tech industries and companies. So we still see a traditional pension for a lot of state employees, especially firemen and policemen, military, etc. But we also still see it if we've got specialized people and we want to make sure we keep them. So we see a small group of these big pensions, and we also see these other 401k style pensions. And we'll talk more about the differences in a minute. But you need to understand that this is still a big part of what we do in the United States in GAAP, because we are still accounting for pensions a lot, just changing the type and the mix of what kind of pensions we're accounting for. The other reason that this is a really big deal is because those pensions that are still out there and they're still in force and people are still living on them or still earning them because they're from that prior set of contracts, those are big bucks. I mean, we've estimated that the federal government's pension obligation is in the high billions of dollars. They don't really show that anywhere in their financial statements because the federal government sets its own rules for its accounting. And we see very interesting or very reduced amounts of other government entities that also have these big pensions, but they follow GASB rules, Governmental Accounting Standards Board, instead of FASB's rules. So because of that, there's huge obligations that are out there that nobody knows about because of the way that we record them, or those government entities record them, and also because of some of the rules that FASB set up makes it a little hard to see just how much companies really owe. So we need to be comfortable with pension accounting and those rules so that we can dig in, understand, and explain these real pension obligations, both to investors, but also to management teams that have got to figure out a way to pay for them. The next thing we need to talk about are the kinds of pensions, and we can break pensions down in a couple of different ways, and I won't take a lot of time with this because we've already alluded to this. The first way we can break it down is by the type of contribution. The first is what we call a contributory plan. This is where the employee puts money into the pension, and so does the employer. So both groups put money into the plan. When this happens, again, more commonly with a 401k, employees tend to feel a sense of ownership, and they also feel a sense of responsibility. They also sometimes feel a little bit gypped as companies switch from not requiring an employee to contribute to employees having to contribute. There was an interesting argument in one of these Midwest states, and we won't get into details, but it wasn't South Dakota or Idaho where I've taught, but it was another state there in the Midwest. They got into a big fight between a new legislature that wanted to start charging teachers and firemen and policemen, other public employees, a small percentage so that they would start to contribute towards their pension costs. And of course, these individuals didn't want to make the change. They felt that they were gypped. And it actually ended up that the Democrats in the legislature actually walked out of the building and left the state, because without a few of them in the state to be in the floor of the House or the legislature, they couldn't call a vote. They didn't have enough people to vote. So there was this standoff. The Republican Party, this group that wanted to make this change to try to bring the state's budget into balance and pay for these pensions, trying to make a change. And you have this other group that has simply left the state. And we could talk about the maturity of both groups. We won't get into that. This is not a political class. But I just want to make sure you understand this is a big issue when you start to switch from the non-contributory plan, where the employer puts everything in and saves it all for you, to more of a contributory plan where both groups are contributing. So it's been a big issue for a lot of companies and for a lot of individuals. The next way that we can break up our pensions is by the company's obligation. Most of us, as we get into the workforce, will get what we call a defined contribution plan. This is the traditional 401k. The employer commits to save for you, and that's all the employer commits to. So your new employer is not going to promise that you'll have $500 a month for the rest of your life after you retire. Instead, they'll say, if you save 6%, we'll save 6% with you. And then you can make decisions on how you're going to invest, and eventually that will roll in and become part of what you have when you retire. But if you invest poorly or if the stock market does bad, that's not our problem. And that's the big deal with a defined contribution plan, is that it's not the employer's problem if you don't have any money. It's your problem. And that's why employers like it. They also like it because the accounting is really, really simple in a defined contribution plan. Because I've just promised to put a specific amount in and save for you, my journal entry is simply a debit to pension expense and a credit to cash for however much I've promised to put in. And that's all there is to it. I have no other obligation, so there's no liability. I have no other commitments now, so there's no more cash going out. It's just, again, a debit to the expense and a credit to cash, and that's it. So when you think 401k, not only does it reduce the company's obligation, but it also reduces the accounting because there's no ambiguity. A specific amount of money goes out of our accounts and into your account that you're saving, and we're done. The other kind of pension is what we call a defined benefit plan. Now, defined benefit plan is what we typically think of as a pension. I hire you to come to a job for me. I'm going to pay you this wage and the salary that we've negotiated for, and eventually, when you retire, I will pay you 60% of your last 3 years' salary over the next 30 years. So they take whatever you made those last 3 years, they average it out, they multiply by 60%, and you get a check for that amount, broken down by month or quarterly or a lump sum every year, and you live on that. That's what we think of when we think of a pension, but it's not the only kind of pension. There are two kinds of pensions, and both of them are really important, and both have to be accounted for. Now, let's take a look at how things have changed over the last little while. What you can see here, and the group that put this together didn't do a really great job as far as color choices, but I'll try to highlight some things. What we have are three different kinds of pension. You have two kinds of defined benefit and one that's the defined contribution plan. And what we see is in my grandparents' day and my parents' day, you see a lot of these defined benefit plans. The darker box are the plans that are open, so they're still getting people into the plan. The gray box are the ones that are closed. So we've hired everybody we're going to hire. We're not going to let anybody else into the plan. So that's the gray box. And what you see here is it starts to drop in quantity. So we see less and less of those defined benefit plans as we move into the 70s, and then it drops again into the 80s, it drops again into the 90s, and now in these 2000s and on, look at how much smaller it is relative to the defined contribution plans. And you can see they were really small up in the 40s and 50s and 60s, but they started growing in the 70s, 80s, 90s, and of course now in the 2000s, that's most of what we're doing is, like we said before, we have a few of these defined benefit plans for public individuals, for really highly specialized or trained individuals that we want to make sure we don't lose. So it becomes a bargaining chip at the table. And then everybody else just gets a defined contribution, and that's it. And again, for both accounting purposes and for legal obligation purposes, it's much better for a company to have this defined contribution plan. Employees tend to like the other defined benefit plans because the risk is on the company, not on the employee. Now, we've talked about a lot of details here, and I don't want to take a lot more time talking about the conceptual stuff because I'm ready to get into some journal entries. But I do want to mention that this really is a big issue, understanding these concepts. And we've talked a little bit about why it's important. But my actual favorite story about this comes from a friend of mine. He's an accounting instructor now at a small school, but he was a union president before of a rather large union. And he loved pensions, loved them. Why? Because he understood them. And the HR negotiator that he used to deal with did not. So they would go into negotiations, and the HR negotiator was focused on the hourly wage. I mean, I've got to get that hourly wage down, down, down. And because he knew what he was doing with these extra benefits, like the pension, he would give on the hourly wage. And to get that concession from him, to get him to drop that hourly wage, he would be able to add in a bunch of stuff about the pension and about other benefits and just kind of ratchet that up for his union members. And so because he understood what he was doing, he was able to help his constituents, I guess is the right word, I don't know, the union members really get better benefits in the future because he knew what he was doing. And this is the kind of thing in accounting we really need to be careful of and understand. How do these really work? How do they affect our business? What are they going to do to our bottom line? Because if they're defined contribution, it's relatively easy. But if they're defined benefit, I'm going to have an obligation on my books for years because of what I have promised to these employees. Now, before we move on, I need to highlight one last thing, and that is the fact that we are not going to talk about defined contribution plans anymore. Because the accounting is really simple. As we've said before, you debit pension expense, you credit cash, and it's done. Sometimes people will get crazy. They'll put it into salaries expense instead of a separate pension expense. But that's all there is to it. Again, there's no obligation on my part. As long as I make my payments every year like I'm supposed to, I have not even a payable, short-term payable on this. I'm just sending out the check and depositing it in their 401k account, and that's it. I'm done. So everything else we're about to talk about is about these defined benefit plans. So keep in mind two things. One, it becomes really complex to keep track of these plans, which is one of the reasons why they're going away. And second, they have a huge impact on our financial statements, which means we really have to be good at this. Because even here, you can see it on this graph, they're not going away. They've reduced and shrunk and gone away quite significantly, but they're not gone. They're still being offered, and so we need to be comfortable with this. And with that in mind, let's talk specifically about what we need to disclose when we're doing a defined benefit plan. FASB has some very specific rules for what we have to include in our financial report. So let's start with the information that's got to go in the financial statements themselves. And we're just going to break this down by our basic financial statement. So let's start with the income statement. You're going to show a pension expense every year. And then, of course, there's a tax effect of that pension expense. On the balance sheet, we're going to have several pieces of information. First, you're going to have a net pension obligation. Now, the net pension obligation is the difference between what we think we owe and what we've already saved on these defined benefit plans. And if I think I've saved more than I'm going to owe, then this net pension obligation actually shows up as a net pension asset, and it's in my long-term investments section of my balance sheet. If, on the other hand, I have fewer assets than I think I'm going to need to meet that obligation, then I'm going to have a long-term liability, and that's that net pension obligation. And we kind of default to calling it net pension obligation as opposed to net pension asset because it's very rare to find a company or a state that has a fully funded pension. Interestingly, I did work at one time for a university system that did have a defined benefit plan, and they were fully funded. And it's totally surprised me when they told me this. I actually asked the HR guy, kind of tongue in cheek, is that legal? Because this was a state entity and most states aren't even close to being fully funded. So anyway, it was neat to work for a group that had planned well enough that they actually were going to meet these obligations without breaking the bank, so to speak. So that's our net pension obligation. That's going to go either in assets or liabilities, depending on how well we've saved. In addition, we're going to have some other comprehensive income numbers. Now, you probably remember other comprehensive income being this set of weird accounts. They haven't flowed into income yet, but they do change our assets. So we have to account for them somewhere. They become part of equity because eventually they're going to flow into normal net income and then into retained earnings. But for now, we're kind of holding them apart in a separate section of that equity part of our balance sheet. So we usually will see two accounts for our pensions, although companies can break them up more. You'll see what we call actuarial gains and losses. This is where maybe our estimates have been messed up or change what we promised to pay people, or we hire more smokers, or we fire the smokers and hire more healthy people. Whatever we do, it changes the mix of employees, and that changes the estimates that are making up our pension. So that's that net actuarial gain and loss. In addition, we'll renegotiate our contract occasionally. And when we do a renegotiation, then it causes what we call a prior service cost, meaning it's changed our prior estimates for our pension. And we see a lot of this right now as companies fight with huge pension obligations that they can't possibly fund. One great example of this was the Hostess collapse. I don't know if you remember this, but Hostess, of course, was a really big, successful bakery. They got in a huge fight with their pensioners and their unions about the pension obligation. And Hostess said, we cannot afford it. We're going to have to renegotiate or close down. And the unions wouldn't give and wouldn't give and union wouldn't give. And finally, Hostess declared bankruptcy, and everybody was out their pension because they wouldn't renegotiate. And you can debate, again, good and bad, pros and cons, but basically they had promised too much and they couldn't meet the obligation, and so the company ended up collapsing. And it was repurchased by other groups, and they bought the recipes, and they're producing Hostess again now, but all of those union workers are out all of their pensions because they couldn't come to a compromise. They couldn't find something that they felt was fair to the employees while still allowing the company to remain solvent. So anyway, that's a prior service cost, is that renegotiation process, and it changes what we owe. It can go up or down depending on the negotiation. Hostess wanted it to go down. My friend, the union president, wanted it to go up, and sometimes it works and sometimes it doesn't. The last thing we see on our financial statements for pensions is the cash that we pay. And there's two ways that this cash can show up. In a direct style statement of cash flows, we show the actual amount of the pension payments. So whatever you invested in the pension shows up as a line item in your statement of cash flows, cash paid for pensions. The other option is in our indirect statement of cash flow. And you probably remember an indirect statement of cash flow, we start with net income and we make a bunch of adjustments and it turns into cash flow from operations. So what we're looking for on an indirect style statement of cash flows is the adjustment for pensions. What's the difference between the pension expense and the cash paid for pensions? And the easiest way to think about this is to simply write down the expense versus the cash. So let's use a simple example. Let's say that I had pension expense of $16,000 and I contributed, let's say, $20,000 over the course of the year. So if I wanted to figure out what this line item, what this adjustment was going to be, I would start out with a line. Here's my net income number. And specifically, it's not net income, it's the net income pension expense. And we said that was 16,000, and it's negative because it's an expense. And then we would do the 20,000, that's what we actually paid. So this will be our cash flow, again, for pension. And it's 20,000. So I need to get, again, from the net income number to the cash number to go from 16,000 to 20,000. I'd show a $4,000 adjustment on my indirect style statement of cash flow. And that would be what shows up on that statement for pensions. Nothing else, just that one number. Because the payments made to the employees or the retirees, that's all taken care of by the pension fund. So each of our big financial statements is affected by pensions. We've got an expense, we've got some balance sheet items, and then we have a cash flow amount as well. Last thing we want to talk about, and I know it's time to get to some journal entries, so I'll keep this as quick as I can. We need to talk about what goes in the footnotes. And because this obligation is so big and so complex, and we'll see how much is involved in calculating it, we have a really extensive list of things that have to show up in the footnotes. So we have to include some description of the amount we've saved and what kinds of asset we've saved. So we have mostly bonds, or we have some international stock, or we've got, you know, S&P 500 mix, etc. We talk a little bit about the discount rates we're using, the interest rates we're assuming, the expected return rates we're assuming, etc., and how we came up with those rates. And we also talk about how we're amortizing some of these future costs. And we'll talk more about that later, but just be aware that you have to disclose some of your calculations on how you got to the numbers that get you to this pension expense. And that's the big piece here, is we're showing enough information that you can see what pension expense is going to be. That is more than enough conceptual discussion of pensions. We need to get into some journal entries and some calculations and tables. Fun stuff coming. I'll see you then.